Yes, Brenda, you're still here.
Okay.
Welcome everyone to the first session of Module 3. It's all about business finance, and we have the great and distinguished pleasure of having Danny Martinez present us the information. He's from Apex Business Consulting, a partner of ours, an expert in the field, and will be here to not only present the information, but he himself is a resource for you as you support your own networks. So without any further ado, Danny, take it away.
Well, thank you all for taking the time out of your schedule. I know you guys been on this for the past couple of weeks, and this is the last module, so I'm going to do my best to keep everybody on course, on time. Just a personal disclaimer: I'm actually battling COVID myself, so just want to let you guys know. So if there's sometimes I might have to put on pause for a quick second, get some chloroseptic, and get back into it. I feel actually pretty good, so I felt worse with other colds in the past, so I'm going to push through this the best I can. I may lean on you from time to time to read some of the slides to give myself a break, but I'm doing my best to get through this, okay? So a little bit about Apex Business Consulting. Apex Business Consulting is centered around making business opportunities possible. We help our clients close the gap between their current state of business to that of their desired future state of business, and we do that through business development, business management, contract negotiation, and succession planning. And we like to work with our clients in a manner that brings out the best of them. And we call this the Apex Factor. Okay, so that's what I tell a lot of my clients when I work with them. I'm trying to help them close that gap between where they're at now and where they want to be. This session, this module 3, is going to be focusing on business finance. So just think of it as the previous class that you took, and the one before that was like 101. The one you just took was 201. And now think of it as a 301 class, kind of like a junior level, almost a senior level of class in college. So I'm going to begin, and I'm not 100% expert in everything. I put some slides together to the best of my ability that hopefully explains what I want to convey throughout this, which is to give you guys a general working knowledge of some of the business practices that our businesses use in regards to their business finances. So if there's something that comes up that you guys feel that you want to talk a little bit more about, elaborate on, ask questions, or give your personal input, please do so. This is a two-way street. I believe in communications both ways. So please let me know, or give Daniel a heads up, or raise your hand, and he'll let me know, hey, there's a question on the table. Let's go ahead and address those questions. Okay. With that said, let's go ahead and get started on the first slide here, and a balance sheet. Okay, what is the basis of a balance sheet, right? The balance sheet is one of the 3 fundamental financial statements and is key to both financial modeling and accounting. The balance sheet displays the company's total assets and how these assets are financed through either debt or equity. It can also be referred to as a statement of net worth or a statement of financial position. The balance sheet is based on the fundamental equation assets equals liabilities plus equity. Okay. Here's a quick snapshot of a simple balance sheet you may see on a small business's books. Again, total assets, current assets plus non-current assets, total liabilities, current liabilities plus non-current liabilities, and then total shareholders' equity, share capital, plus retained earnings. And we're going to go into this a little bit more in detail. So if you don't understand something from the get-go, we'll go into more detail as the slides unfold. How the balance sheet is structured. You may ask yourself, why do I need a balance sheet? How is it structured? Why does it make sense? Or do I have to have a balance sheet? And a balance sheet is like a financial statements. They will have minor differences between organizations and industries. However, there are several buckets and line items that are almost always included in common balance sheets. And those are current assets, long-term assets, current liabilities, long-term liabilities, and equity. Okay, so your current assets, like what do you currently have on hand that's liquidable? And we'll get into that liquidity here in the next slides or two. And again, long-term assets, current liabilities, long-term liabilities, and equity. Cash and equivalents. Okay. The most liquid of all assets is, of course, cash, right? If you have a pile of cash, someone can say, hey, I need to borrow some money. And you can get a stack of $100 bills and say, here's $1,000. That is liquid. That is cash assets. That is the most common line of liquid assets is going to be in forms of cash. And I'm pretty sure everybody can relate to that. If someone needs to borrow $20, hey, let me borrow $20. That's liquid cash. And it appears on the first line of the balance sheet. Cash equivalents are also lumped under this line item and includes assets that have short-term maturities under 3 months or assets that the company can liquidate on a short notice, such as marketable securities. Companies will generally disclose what equivalents it includes in the footnote to the balance sheet. Accounts receivable. Okay. This account includes the balance of all sales revenue still on credit. For example, if you are a bakery or you are a shoe store or you sell a service and you sell those to an organization or individual and you have not received money for that, that's going to be an accounts receivable. Basically, it's money in the good, but this money has not been collected yet. Okay, so it's basically this account includes the balance of all sales revenue still on credit, net of any allowances for doubtful accounts, which generate a bad debt expense. As companies recover accounts receivables, this account decreases and cash increases by the same amount. So whatever you sold and you haven't collected on, you want to make sure that's exactly the amount that is owed directly to you. And you want to have a good balance between the two. Again, inventory. Inventory includes amounts for raw materials. Okay. What raw materials are, what it takes to make that product that you're selling, that widget that you're selling. Work in progress, goods, and finished goods. The company uses this account when it reports sales of goods, generally under cost of goods sold in the income statement. Okay. Non-current assets. I know we've been hearing the PP&E, so it's not PPP or PPE, it's plant, property, and equipment. Capture the company's tangible fixed assets. This line item is noted net of depreciation. Some companies will class out their PP&E by different types of assets, such as land, building, and various types of equipment. All PP&E is depreciable except for land. So when you have these certain assets, such as a building, that is an asset to the company. Or say you move rock, sand, and gravel, and you need a big dump truck to move that product for your client. That what you have there, that truck is also considered an asset. So think of an asset as something that you actually could buy and you could depreciate it over 5, 10, 15 years. Unfortunately, you cannot depreciate land because land does not fall into that category. So intangible assets. This line item includes all of the company's intangible fixed assets, which may or may not be identifiable. Intangible assets include patents. So if somebody has a patent on how to do something, how to make something, how to build something, that is a specialized patent, and or license, and secret formulas, such as recipes for cooking or recipes for that special pizza that you have. Unidentifiable intangible assets include brand and goodwill as well. Okay. Let's look at some current liabilities. Accounts payable, or AP as they call it, is the amount a company owes suppliers for items or services purchased on credit. For example, if you say you need some cement, right, and you need to lay a foundation, you're going to get that cement for your foundation, but you're going to get it on credit. Okay, and that's accounts payable. As the company pays off their accounts payable, it decreases along with an equal amount decrease to the cash amount. And then you have current debt and notes payable. Includes non-AP accounts payable obligations that are due within 1 year's time or within one operating cycle for the company, whichever is longest. Notes payable may also have a long-term version, which includes notes with maturity of more than 1 year. Current portion of long-term debt. This account may or may not be lumped together with the above account. Current debt, while they may seem similar, the current portion of long-term debt is specifically the portion due within this year of a piece of debt that has a maturity of more than 1 year. For example, if a company takes on a bank loan to be paid off in 5 years, this account will include the portion of the loan due in the next year. Does that make sense? Okay. Non-current liabilities. Bonds payable. This account includes the amortized amount of any bonds the company has issued. So from time to time, when companies need to raise money, they'll issue bonds. And that's long-term debt. This account includes the total amount of long-term debt, excluding the current portion, if that account is present under current liabilities. This account is derived from the debt schedule, which outlines all of the company's outstanding debt, the interest expense, and the principal repayment of every period. So the next few slides are going to show a little bit more in detail what it looks like on the balance sheet itself. And we can ask any questions if you guys have any questions. So shareholders' equity. What is shareholders' equity? This is the value of funds that shareholders have invested in the company. So when a company is first formed, shareholders will typically put in cash. For example, an investor starts a company and seeds it with $10 million cash, an asset rises by $10 million, and share capital, an equity account, rises by $10 million, balancing out the balance sheet. So in layman's terms, say for example, you're a small business and you want to open up a pizza store, a pizza shop, right? And you have about $5,000 saved. But it's gonna take about another $50,000 to get the business going because you got to buy product, you got to buy machinery, you got to pay rent, you got to pay for some employees. So then you borrow money from friends and family or a bank, and that kind of is the best way to explain share capital. It's money that is raised to get the business started. Okay. Retained earnings. This is the total amount of net income the company decides to keep. Every period, a company may pay out dividends from its net income. Any amount remaining or exceeding is added to, deducted from retained earnings. Okay. I know
So
this
is that like a sales or savings account, like if we're talking about an individual?
Yeah, you could look at it in that way, Daniel. That is another way to look at it. Yes. Okay. I know there's a lot of information, but I'm gonna do my best to bring it down to layman's terms as possible. Um, the importance of a balance sheet. The balance sheet is a very important financial statement for many reasons. It can be looked at on its own and in conjunction with other statements like the income statement and cash flow statement to get a full picture of a company's health. So a balance sheet is kind of a snapshot of a company. you can kind of see exactly where the company is at by looking at their balance sheet. It'll tell you how much cash flow the business is generating. It'll tell you how much equity the company has, and also showcases income statements or financial statements of the business. And businesses have this, and well, a lot of businesses will be asked for this from a bank if you're looking to get another loan, or you're going to get a loan from the SBA or other entities that will let donate or not will actually let you borrow cash. They want to look at your balance sheet because it's a quick snapshot of where the company's at and see if the company's in debt or they're in the red or in the black, basically. Four important takeaways I would say is going to be liquidity, leverage, efficiency, and rates of return. Okay, liquidity. Comparing a company's current assets to its current liabilities provides a picture of liquidity. Again, current assets versus current liabilities, money that is owed, and current assets, how much value do you have in those assets? So, like I said, back to the cement truck scenario, you're a cement company, you have multiple trucks for your cement business. Those trucks are current assets. Okay. Current assets should be greater than current liabilities, which makes sense. So the company can cover its short-term obligations. The current ratio and quick ratio are examples of liquidity financial metrics. Leverage. Looking at how a company is financed indicates how much leverage it has, which in turn indicates how much financial risk the company is taking. Comparing debt to equity and debt to total capital are common ways of assessing leverage on the balance sheet. Efficiency. By using the income statement in connection with the balance sheet, it's possible to assess how efficiently a company uses its assets. For example, dividing revenue into fixed assets produces the asset turnover ratio to indicate how efficiently the company turns assets into revenue. Additionally, the working capital cycle shows how well a company manages its cash in the short term. Okay, rates of return. The balance sheet can be used to evaluate how well a company generates returns. For example, dividing net income into shareholders' equity procedures, return on equity or ROE, and dividing net income into total assets produces return on assets or ROA. And dividing the net income into debt plus equity results in return on investment capital. Excuse me. What is an income statement? You might ask yourself, what's an income statement?
Hey, Danny.
Go ahead.
Before we go on to the income statement, can we just, in my mind, I'm thinking for the balance sheet, it harkens back to me kind of similarly in that personal finance piece to just keeping a budget, keeping track of all of the ins and outs, right? How much money do you have on hand? What does your debt look like? So is this kind of like that, the accounting and like personal accounting and the budget of a business?
Yes, it's very similar. You can look at it in that way, Daniel. Thank you for explaining it like that. Yes, you kind of want to see how much you have on hand. So if you want to relate it to the personal side of things, it's like, okay, you have a house, you have a couple of cars, you have some money in the bank, and you have a couple of dollars under the mattress. Okay. Those are your current assets. Okay. Current liabilities is like, how much do you owe? You owe your phone bill, you owe your electrical bill, you owe your cable bill, you owe your cell phone bill. Those are your current ongoing liabilities. It's very similar to your personal finance, but it's on the business side of things. And you may have more liabilities because running a business is costly. It's not that it costs more than operating a household in your personal financial statements, because just usually you get money coming in from your paycheck and you pay your electrical bill, you pay your heating, your gas, you put food on the table, and that's pretty simple. But when you're in the business finance model, you have other liabilities such as employees, their salaries. If you have insurance, you're paying insurance for your employees, or workers' comp, or if you have, you say your employee, you need to buy your employees computers and laptops and printers so they could do their job efficiently. Those are all additional expenses that have to be incurred by the business in order for the business to operate.
That's great.
Okay.
And I think Kevin might have a question here too.
Well, I'm just wondering if you would, just to further the analogy, I'm just wondering if it's helpful for laymen, folks who aren't used to business. I wonder if a good way to look at this is that, it's all of these balance statements and everything that you're talking about, Danny. I wonder if it's it's just different ways of looking at the business and what the where the money is going. So, for example, in personal income, if I own a home that's worth $500,000 and I owe 250 on it, my net worth might be $250,000. But if I don't have a job and I have no income, it kind of helps me see from all these different statements whether or not this is actually a viable situation or not. What's my, I'm on paper, my net worth might say I'm worth $250,000, but my cash flow is telling me I'm in trouble. So I don't know if that's helpful or if you agree with the analogy, but it seems like that's what all these business statements are trying to help us see, is the crystal clear picture of the overall business.
Exactly. And that's a very well way to explain that. And thank you for the insight on that. And again, if anybody else has a better way to explain it or has an example, please bring that to the table for a topic of discussion. I'm real open to discuss that in detail. But yeah, that is just another way of looking at somebody's overall balance, their financial well-being. If they have a house and, like I said, it's worth $500,000, great. And it's, they only owe $200,000 on it. That's great. You can see you can have about maybe $300,000 in equity on that home. So that's would fall under the liquidable, because you're able to say, for example, you need to borrow money or you need to buy another piece of equipment. You could borrow money out of that equity of your home to purchase that extra bulldozer or bobcat that you need to successfully run your business. So it's just another way of looking at it in layman's terms. So yeah, that's a great example. Thank you on that. Going back into an income statement, what is an income statement? It's basically a financial statement that shows you how profitable your business was over a given reporting period. It shows your revenue minus your expenses and losses. That is pretty basic. So how much revenue you're bringing in, how much did it cost you to earn that money? Your employees were expense. You had to buy that laptop. You had to buy that extra machinery. You had to buy some more raw materials. Those are your expenses. And then, did you take any losses on that? And that could be from, you didn't get paid on time for that job that you did. Some of the employees, file workers' comp, and you have additional costs associated with that. So again, your financial statement is a snapshot of revenue minus your expenses and your losses. Okay, that is also sometimes called the net income statement or statement of earnings. The income statement is one of the three most important financial statements in financial accounting, along with the balance sheet and the cash flow statement. Small businesses typically start producing income statements when a bank or an investor wants to see how profitable their business is. So if you're looking to ask for another loan, or you want to expand your business and you want to buy another business, or you want to add another addition to your business and you need to borrow some money, the bank's going to say, hey, let me take a look at your income statement. And by doing so, they should be able to see exactly if in fact the company is in the red or in the black. Are they profitable or are they in the negative? And when a business makes an income statement for internal use, they usually are more likely refer to it as a profit and loss. So you'll hear it referred to as a P&L statement or profit and loss statement. How the income statement and other financial statements work together. Okay, your income statements are most powerful when used in tandem with your balance sheet and cash flow statements. Okay, a balance sheet tells you everything your business is holding on to at a particular point in time, your assets and liabilities. The balance sheet tells you where you are, while the income statement tells you how you got there. Does that make sense to everybody? Okay.
Yeah.
Okay. A cash flow statement tells you how much cash you have on hand and where it came from. This is essential if you use the accrual basis of accounting. Under that system, you may have recorded income in accounts receivable. For instance, an invoice you sent to a client before you've actually received the payment. So you can show it on your statement, but the money has not come in yet. And that's good for planning future income, but not good for knowing how much cash you have to work with. The cash flow statement gives you a clear view of what you have to spend right now. So think of the cash flow statement exactly what you have that is readily available that you can go and use that money to purchase additional widgets, purchase raw materials, whatever that you need to run your business. And that is kind of the income statement and balance sheet all in one. I know it was a lot of information, and I definitely want to open up for discussion to answer any questions you may have or kind of like get a better understanding of what that is. And I'm going to, if that's okay, Daniel, I'm going to exit out of my PowerPoint so I can see people because I'm just looking at my PowerPoint.
That's perfect, Danny, and I love the fact that you're turning this back over to everybody to kind of discuss. I'm really interested. If I could just kind of ride the coattails there, I'm really interested to hear from you all. What questions have you received from your network, from entrepreneurs and business owners, in support of them regarding financial reporting, the balance sheet, the income statement, etc.?
Well, for me personally, it's interesting because, I'm majoring in finance, and actually last quarter in the spring, I took a class that was just straight breaking down all the financial documents, but it's more on a like corporate level. And so I really have no idea like what it's like to, to try to like analyze the information on like a small business, local business. So I've been trying to, get my roommate to show me his balance sheets so I could start getting more experience, but he's really reluctant. So, but I would like to look into that and see that, because I think that, they're, while they're both relatable, I think that they're also like two different worlds, and there's a lot of value in both of them.
Agree. And what do you see from the corporate finance side of the house? Because I know they're very similar but different. And what is your viewpoint on the corporate finance side of things?
Well, like with the corporate, for example, like right now we're looking at really, um, you know, taxes and what we call free cash flow. So basically the analysis of a company's worth, or a project's worth. And so essentially, like if you were to ask a person, what is the worth of a company, like, or what's the value of a company, it can be very subjective. So that's where finance kind of differs from like accounting. Accounting is straight numbers, but with finance, we have the way we tally values through cash flow. So if we can predict and say, hey, this company is going to bring back, I don't know, like $50,000 next year, and then $70,000 a year after, and then et cetera, and you keep going. Then what you do is there's a formula where you basically you add all that up and you discount it back to the current time frame, because with companies, they have debt, they have bonds and shareholders and stockholders that need to have a certain what's the word, like um requirement or return, excuse me, they need to have a certain return met. So with the corporate side, it's more just about like the valuation of like projects and the company and the free cash flows. But I feel like with small businesses, it might be more concerned on just like the actual bookkeeping side of it, so more of the accounting and making sure that, like, hey, are my, like, is my revenue covering my expenses and taxes and all that. So
I think you nailed it right there, Kareem. Very, very insightful, because a lot of these businesses, these small businesses, they see only the revenue that's coming in. So just because they have maybe $500,000 in revenue, that doesn't mean that's $500 that goes back to their bank and that's in their own pocket. So they're like, well, I'm
yeah,
doing great on my revenues, but they're like, well, once you actually do the income statement and you say, well, look at all my losses, look at all my expenses, it's not really the true $500,000. So maybe out of that $500,000, they probably bring home maybe $80,000 because they have all these other additional expenses. And I think businesses get themselves into a jam because they see only the revenue line coming in and like, well, I'm good, I'm good, I'm good. And then when they have to do their taxes, they're like, wait a minute, where's all your losses at? Where's all your additional expenses? And then that's when they get themselves into trouble because they think they could spend that money down, and that money's really not their money. And that's
exactly. Yep.
where they get themselves into a lot of trouble. And before you know it, their rent goes up, the cost of goods goes up, the cost of production goes up. And before you know it, they're finding themselves in the negative. And that is the main thing, the main takeaway from a balance sheet is that for the business owner to understand exactly where they're at in terms of the financials, basically the current liabilities, the current assets, and those are the two things that are going to be able to balance the company out going forward.
So, Danny, I might just throw in that there's certain things that we can do as, maybe side hustles, or it could be rental property, things that are revenue generators, but it's real easy. And I know from personal experience, it's real easy not to really treat it like a business. And you kind of sort of know what the cash flow is. You kind of sort of know what you need to be charging for rent and stuff like that. But if you're not doing these balance statements, you don't really have a crystal clear picture of what's going on. And it might be, uh, it might really help direct your decisions as the owner of those things. That, if it's rental property, you might realize, my taxes have gone up so much, or my insurance has gone up so much that, I maybe I need to make some adjustments there or whatever. But anyway, I think it's just real easy to just kind of go at some of these, thinking about, you could start a blog for example, and start making some money that way. But it probably makes sense to keep track of all these statements just so you know what's what. I think it's real easy to lose track of where
Exactly.
the real health of the business.
Exactly, Kevin, and very insightful on that from your point of view. And these small businesses, they seem to find themselves into some type of that they seem to do okay, but when it comes down to actually filing the taxes and actually reporting that money is where they fall into that trouble spot, right? And that's why it's so important to have an update of on a quarterly basis. You know, where are you at now? Q1, Q2, Q3. So when you're ready to file your taxes, it's not like, oh my gosh, I'm in trouble. I need to figure it out. Where did this money go? Right.
Right.
And that's so important. So you'll have small businesses come to you because everybody wants to talk positive about their business. Nobody ever wants to share the downside of their business. And I think that's one of the challenges of us and Latino-owned businesses and African-owned businesses. It's kind of a pride thing. They don't want to swallow their pride and say, I'm actually having a hard time here. My income statement is not the way it's supposed to look like, but I'm going to tell you that business is great because they want to believe that. It's kind of like a self-fulfilling prophecy that they want to believe in the business so much that it's actually a success. But in reality, when you actually crunch the numbers and look at that income statement, like you're having a little more losses. You know, you didn't accommodate for the cost of goods going up. Like nobody could even plan for this whole COVID stuff, right? Nobody knew that this thing was coming down the pipeline, right? And so nobody had any emergency funds set aside. Nobody had that extra cash set aside or that line of credit. And now that we're in this jam that we're in, now everybody's trying to scramble and try to get the additional money to save them out of the situation that we're in right now. Granted, this has never happened to us before, and hopefully it never happens to us again. But those small businesses still have to pay that loan that they borrowed from the bank. They still got to pay that United Rental where they borrowed 2 or 3 Bobcats to finish out that cement that they did, that foundation, and that they had to move all that dirt. Those bills are still coming due. Same thing with the rent, you know. And a lot of these businesses are in that catch-22 now. And I'm curious to see how this is all going to actually play out now that this PPP loan has come into effect. These SBA loans, everybody's basically giving away money. I'm curious to see what is that going to look like in Q1 or Q2 of 2021. What is that going to actually look like? And it's those businesses who did not take that money or who had a good understanding of their income statement that said, wait a minute, I'm not going to take this money because I don't have enough money coming in to pay this back. And that's where they get into some challenges. Anybody has any other situations or small businesses that is an example of this?
I have a girlfriend that had a daycare in the same situation, but she did not take the loan. And she called me yesterday and she said she had a daycare center. And as soon as they told us about the small business loans and this, that, and the other, she said, I immediately sold all my equipment, all my everything at the nursery to another nursery. And she said, that lady called her and she said she took the loan and she can't even pay her employees now. So I said, that's terrible.
That's a prime example, Brenda, that these small businesses find themselves into. And that's a great example of liquid assets. What is actually liquidable? When we talk about liquidable assets, it's basically saying, how fast can I turn this widget, this machinery into cash? Because when the bank or the IRS is asking for their money, you need to return that money as fast as possible. So am I going to sell my cell phone? Am I going to sell my desk, my computer, my laptop, whatever is liquidable? And I think of it as like going to a pawn shop, which I hate. That's a terrible example to use, but that's the best way, an example of liquidable assets, right? You're going to take this item that you have because you need money. You're going to take it to the pawn shop and they're going to give you money on that item, but they're not going to give you the full amount of that money of that item that is valued of it, right? So that becomes a challenge. Because when you think that you bought your cell phone for $1,000, you take it into a pawn shop, they give you $300. You're like, well, where's the other additional $700? Well, it's not there. And that's where people fall into those bad situations where they start liquidating their assets.
Yes.
So if that daycare, if she has any other additional questions she would like to ask, or she, she's in a situation where she has that PPP loan or she took out another loan that she may need some questions answered, please have her give me a call, and I'll be more than happy to at least talk with her and see if we can find out some other solutions to save her business.
Okay.
Good question. Yes, thank you. Anybody else? Catalina, Simon, Jasmine, anybody else have examples? Veronica, are you guys there?
No, I don't. The ones that I've heard are very good.
My brother just opened his small business, but he hasn't taken out any loans. So he's not in that situation that I'm sorry, what's your name?
Danny?
Brenda was talking about. So business is just slow right now, but he's doing okay. He's not losing money. He's like at an even point right now, but it's just because everything's slow.
What type of business is it, Catalina?
It's a food trailer, a food truck. So
Yeah.
I think right now it's going okay just because he barely started, so at least the cash flow is coming in, and he didn't take out any loans for anything. He just used his money. So
Where is it located?
off of Alameda and Federal, 158 South Federal. I always had to put that plug in there,
Mhm.
No, that's good. That's good to hear. The biggest thing about the food trucks is they got to watch out for the spoilage because, they buy X amount of food, and if they cannot sell that food that day, they only can keep it on the truck before it goes bad, maybe 2 or 3 days. So my only advice to your brother and his business is just make sure he watches his inventory and he actually keeps a good account for what are his top items that sell to make sure that he doesn't get into a bad situation where there's too much spoilage and he's actually throwing away shrimp or carnitas or whatever that may be because they're not selling as fast as he thought they would.
Yeah, he's doing actually really good. He did take some things off his menu because they weren't selling as well. Exactly. But luckily, he hasn't had very much spoilage, and he sells what he makes for the most part.
Perfect. Good to hear that.
And I think Jasmine might have been wanting to say something there too. I saw her video. Jasmine, are you there? Go on mute, Jasmine.
Yeah. Sorry. But yeah, all of that went over my head, and it's like nothing against you. It's just that's a lot to take in and try to, put together. And honestly, I took accounting in high school, and I was traumatized then, and all this is just bringing back memories. So,
wow.
But I know it's needed, and I just need to go back through the slides slowly and
No worries. And my goal was to basically give you high overview, and if there's one-offs that you need to have, you have a question, feel free to call me offline and say, hey, Danny, could you explain a little bit more about that? What does that really look like? But to break down the whole all those PowerPoints I gave to you right now, it's basically looking at a business and getting a snapshot of where they at financially. That's basically what it comes down to. An income statement is like, all right, how much money is the company bringing in? How much is expenses going out? And what's the balance? So if you look at it as basic plus and minus, that is the best way to look at it. Don't get confused with all the other verbiage and accounting verbiage that they use. Just think of it as a quick snapshot. If you were to look at a business and say, is this business making money? Yes or no? And an income statement is the best way to explain that. You're always going to have money going out because you're always going to have additional expenses to run your business. For example, Catalina's brother who has a food truck. So he's going to have insurance on the truck. He's going to have food that has to buy. He's going to have propane gas tank, whatever that he uses. He's going to have gas for the truck itself. He may have to pay for his spot. So that's all money going out because it costs money to run a business. So those are expenses going out. Money that's coming in is his friends are buying 5 tacos a piece. So he sold 5 tacos to Jose, 10 tacos to Sarah, 15 tacos to Mark, etc., etc. That's money coming in. And you want to basically look at it that, do I have more money going out than I have coming in? And that is basically what a balance sheet is, an income statement is. It's like, where is the company at right now, statement wise?
Thank you for
You're
that.
welcome.
That was just straight to, without the verbiage, it's so much easier
I understand. I understand. And it's hard to deliver a lot of information. And I'm gonna apologize going forward because a lot of the slides are kind of geared towards that. I'm gonna try my best to simplify it the best way I can. But sometimes accounting terms are accounting terms. There's no other way of explaining it and breaking it down. I mean, that's just the bare math and the basics, the way it comes down to. But at any point in time on through the next presentation next Wednesday, if we get to 2 or 3 slides, you're like, wait a minute, throw up your hand, stop, and we'll explain that a little bit more in detail so you can capture everything that we're trying to explain to you. So again, our goal is to basically give you a working knowledge to entertain some of those general questions that you may have from the small business owner. And then if you get into a certain situation, like, wait a minute, it's a little bit more than what I know, or I don't want to get back into the weeds, then you reach out to Daniel, you reach out to myself, and then we'll get in contact with those individuals and entertain those questions on a one-to-one basis. We don't expect you all to be accounting or CPA majors to get this done. It's just a basic general understanding. So think of it back when you're in high school, when you're back in the day, like, oh, I remember some of that stuff. That's exactly how we want you to handle it. Just the basics. So, any other questions, any other input, I'd be more than happy to entertain. If you have an example of a small business that's, going through some of these challenges, this is the time to talk about it. This is a free, open communications platform that Daniel's created. So we want you to feel comfortable and confident that you can ask questions. There's no wrong answers. There's no dumb questions because I myself, I don't know everything. So I'll be the first one to admit I don't know everything, and I'm going to ask questions.
I was just going to add too, and this is something that goes along with what you're saying about like simplicity. Sometimes just even looking at the cash flow can be really, really important. I assume, especially for smaller businesses, because like you mentioned before, you're seeing, okay, how much cash do I have? Sometimes you're looking at a income statement, you can get tripped up if you start like factoring in like taxes and and because it's on an accrual system, someone may you may provide a service for someone and then they may not pay you, and so you're like, yeah, you mark it down as revenue, but hey, you didn't get the cash, or maybe you expected to get the cash, but then you find out you never got the cash. So sometimes I think before you even get to an income statement, really look at the cash flow and just figure out how much cash you're bringing in and out. And that could be super, super helpful to make sure that you don't get tripped up because, they say, unfortunately, one of the number one statistics that, business loves to throw out is like, I think 90% of small businesses don't make it past 10 years.
Yep.
Like it's like a huge amount. So, there are different reasons for it, But like you said, sometimes it just comes down to pride, and especially for marginalized people, people of color. We're really, it's hard for us because like we're facing so many different things. We want to be, like not ever have a bad day and not acknowledge our weaknesses, but we have to unfortunately sometimes be like 3 times better than the competition. And if we're not, then we kind of like avoid that. But we have to be realistic, and sometimes you can't always be 3 times better than everyone else. And you may not need to be 3 times better than everyone else all the time. So just being aware of all those different things.
Very well said, Kareem. And you just touched base on accounts receivable. That's a great example. And I'm going to give you guys another example of an accounts receivable. And it's kind of funny, but you remember the movie Dumb and Dumber, right? Yeah, everybody's seen that movie Dumb and Dumber, right? And they're borrowing all that money, right, from that suitcase that has all the money. They're borrowing all that money. They're buying all kinds of. They're going to dinner, buying them that Lamborghini. You buy, going there, buying the fur jacket and the boots and everything. And they're like, "Well, where's the money at?" He goes, "Well, it's all right there. What are you talking about?" And he opens up, has all kinds of IOUs, right? Remember that scene? They're all IOUs. Well, that's the exact same thing what accounts receivable is. It's like it's money owed to you. It's on paper. You could write it up and you can claim it, but until the actual money comes in, it's just like an IOU. It's just paper. It's just tracking of the money. And it doesn't really show. And that's definitely not a liquidable asset, right? You can't take all those IOUs and go to the bank and say, "Hey, can I cash all these IOUs in for, give me $1 million? I got they're all right here. It's all IOUs." It doesn't work like that. So that is probably my best example that I can give you in terms of accounts receivable and what actually plays out in small business world. Go ahead, Brenda. You're on mute.
I would like to say, everybody go and vote, because some of this accounting tactics that Dan is talking about is what Trump is doing and has done.
Amen.
Amen to
Brenda. Amen, Brenda. We'll take you on your advice.
Danny, to Jasmine's point about this could get really complicated. Like even if I had someone in my network who's an entrepreneur wanting to get their foot into this, even with my experience, I don't feel that I would be able to really walk them down the accounting path. Are there resources like the Small Business Administration, the Denver Chamber of Commerce, that would offer kind of accounting 101 classes? What is a balance sheet? What is an income statement? Who our trusted community members here might be able to refer their network to?
Absolutely. You want to look at Colorado Enterprise Fund, CEF, Colorado Enterprise Fund. A good friend of mine, Alan Ramirez, works there. I know First Bank is always willing and able to engage the community and share with them the basics of opening a bank account and answer those questions. Same thing with Key Bank. Key Bank is another family-friendly bank that is always open to entertain any questions. Mi Casa Resource Center, one of my clients, they are very, very open to entertaining questions relative to small business or personal finance. That's what they're there for. And it's a free service. So please reach out to those entities or associations that can help you entertain those questions. If you don't get a hold of anybody, please contact Daniel or myself, and we'd be more than happy to do an email introduction, a phone introduction to those key individuals that will answer those questions. And usually it's going to be free of charge. You shouldn't be paying for free education and advice. So if somebody says, "Hey, I'm going to charge you $500 for a consultation," please go a different way, different direction, and ask us, "Hey, I need some help. My friend is in a situation. They need to sell their business or they're in trouble. Could you please get us some information?" So that's what this whole DMCI is all about, is basically getting the right information to those individuals to get those questions answered.
Hey, Danny, do you have a preferred software package for doing these type of things? Or have you seen a variety of them, I imagine?
There's a variety of them, Kevin. I mean, there's so many out there. Some of them are going to be at price parity with one another. You're going to find some that are really expensive. Like QuickBooks. I know QuickBooks has a big name, but not all small businesses need QuickBooks. There's a smaller version of it. It's slipping my mind, but it's geared towards the smaller end of the businesses. So people automatically get stuck on that whole I need QuickBooks because that's the biggest thing out there. And quite frankly, no, you do not really need a QuickBooks software. You need something that's smaller and is curtailed to your business. So your CPA or your accountant should be able to give you some general direction and advice on what software to use. But if you get into that situation, you're not still unsure, feel free to give us a call and we'll definitely relay you to those business softwares that can actually help you and your business going forward. And, if you're basically starting off, pen and paper, basic pen and paper and a calculator will solve 95% of your challenges on accounting. I mean, it's just in the latter years that all these other software companies that got into the business and they started making money on it. But you could do all this by pen and paper. We've been doing it for years. This has been conducted over 100 years by pen and paper, by ledgers, and it is very simple math. It is now so in today's era where people think they need all this fancy software, you really, really don't. You need a pen and paper, calculator, and a big eraser, and you should be good. But other than that, I think we're upon our time.
Yeah, and actually, if I can say thank you again, everyone, for coming in. I'm going to stop the recording. I do have a few things that I want to discuss very briefly.